It's Brian Preston, the money guy.
I want to give you one huge planning opportunity.
Huge.
Because I think it will be around. And we're doing this personally, and I want to share some of the things we're doing. Health savings accounts. I love health savings accounts because...
Do you love them enough that we did an entire show on them?
We did. If you go join the Smart Money Club at moneyguy.com, all we need is your email address, and then you can quickly go do a search on health savings accounts. We did an in-depth show on health savings accounts, go much deeper than what we're going to be able to cover today. But here's why we love health savings accounts. They are triple tax advantaged.
You heard that right. That's 3 times. Triple
tax advantage. I feel like if I was a wrestler, this is something we'd really spend a lot of time, just, carrying the tennis racket and really yelling about, because triple tax advantage sounds awesome. Here's the triple. Here's where the 3 are coming in. The current year tax deduction. That's right. The government gives you a tax deduction for making contributions to your health savings account. In 2017, that is $3,400 for an individual, $6,750 for a family. In 2018, it'll go up again to $3,450 or $6,900 for the families.
But Brian, what if I'm a high-income household? Surely I won't get that tax deduction, will I?
Nope, still getting it. It's triple tax advantage. So you get the current year tax deduction, and then it grows tax deferred. So you keep this, if you don't use the money for actual health cost, the money can be invested. You can go buy mutual funds, you can go buy, investments, so this money can grow, and that growth is tax deferred, while it's growing. And it's not a use it or lose it moment. It's not like a flexible spending account where, at the end of the year, if you didn't use all your money, oh no, it's going away. So you're loading up on all the stuff, to make sure you spend that money. Right. No, you can roll this money forward and keep letting it grow tax deferred. So that's the second thing. It's tax deferred. But here's the third thing that really makes the triple tax advantage huge. It's tax free if you use it for medical purposes. So think about this. The government is totally, in a good way, blowing it on this thing. And the fact that they're giving you a tax deduction on the front end, so you never paid income taxes on what you put in the health savings account. And then if you use it for medical purposes, the growth is completely tax free. That's incredible.
Unheard of, even.
So that's why it's triple tax advantage. And here's the planning opportunity for all my money nerds. And this is what I'm doing. Here's what you do. If you have enough liquidity in your life that you don't actually need to reimburse your medical expenses from the health savings account, you make those annual contributions to the health savings account. So if you're a family, you have a high deductible health plan, because that is a requirement. You do have to have a high deductible health plan. So that means go have very high deductibles. You're not going to get to use the insurance. You're going to have a lot of stuff flowing through out of pocket. But you put the $6,750 into your health savings account, and then I don't take reimbursement. Now, I keep meticulous records. What I mean by that is I'm matching the explanation of benefits, the EOBs, with the medical bills that come in from my insurance, provider, my medical providers. And then I'm keeping proof of payment as well. When I make those payments, I keep the proof of payment. And then I'm just letting those accounts grow. I've got them invested in a very conservative but growth-focused balance fund, low cost. And it's out there growing, working in the background. That army of dollar bills is going. Meanwhile, I'm documenting and recording these medical expenses. My plan is, and this is an arbitrary number, but this is what I've decided. 10 years in the future, I'm going to go and get reimbursement for that, the first 5 years of expenses. Because there's no deadline on when you can go seek reimbursement.
Hold on, but Brian, at 10 years, you're not going to be 59 and a half. Can you get it without having to pay taxes?
But here's the thing. Since I'm reimbursing the medical expenses from 5 years ago, or 6 years ago, it's going to be tax-free. It's huge. It's a huge planning opportunity. Now, I know where you're going with that, Bo, because here's the other cool thing about health savings accounts. If you get to over 65 and you're a healthy person and you've built up this big health savings account, you can actually use the money from a health savings account for retirement expenses. Now, you're going to pay income taxes on the gains, but you can use it for outside of medical purposes. But what I was talking about was a way that you take the tax deduction and take the tax-free growth is by reimbursing yourself. Essentially, I'm going to have the money growing, house money, because let's give you an example. I put $6,000 into this account. Let's say 10 years from now, it's worth $15,000. Well, I have $6,000 worth of expenses. So I go and pull that $6,000 out for reimbursement of my medical expenses. But the $9,000 of growth from 10 years of working is going to stay in the health savings account, continuing to work for me. That's incredible.
Yeah.
Whereas if I pulled that money out as I needed it for reimbursement, that $6,000 wouldn't have grown into anything. So that's how you're taking advantage of it.